Favourite site this auction?
You'll never see this thing ever, a 2-story Krispy Kreme outlet.
Manufacturing them on site, aren't they?
So you've got everything there.
That's
so
amazing.
They manufacture. I saw the lady cooking donuts there while I was there.
Welcome to the Portfolio Podcast, our first one of its type for Burgess Rawson and hopefully one of many going forward. I am extremely lucky to be in the room with two of Australia's fuel experts. You sell more fuel than anyone in Australia and you know more about it than anyone in Australia. I love talking to both of you about it. Welcome, Jamie Perlinger and Yosh Mendis, and thank you for attending today.
Thanks, Ingrid.
Thanks, Ingrid.
So, start me off, Jamie. We've got 17 fuel coming to market next auction. What's going on there? What are we selling and why?
I think at the moment, what we've seen over the last sort of couple of years, there's been a very low supply of service stations coming to the market, and there's a few reasons for that. I think a lot of the developers out there have got a lot of product that have been coming through that hasn't been ready to come to the market. Also, interest rates have been going up, and there's been a lot of the buyer pool probably has shrunk a lot. I think leading into this year, interest rates are potentially coming down at the start of next year, and there's time to recycle capital.
Something that you were talking to me about earlier, Jamie, which I was amazed by. The top 5 banks in Australia have some market cap of about 500 billion. The top 5 fuel organisations or energy companies have a market cap of almost 2 trillion. What is driving this organisation and why are they building more fuel?
Well, it's all about market share. Drive profits, drive money for the businesses. You look at what Viva have been doing. They've bought Coles Express recently. Also just bought OTR for $1.15 billion. They're doing it for growth. They're seeing growth in the convenience retail market, and they can see that. And additional to that is 7-Eleven. It's just been bought by the Japanese parent company. Why? Growth.
And Yosh, where do you see the value in these properties? What are we looking at when we're talking about yields and we're talking about value and what we're buying them for? What is underpinning that value in these properties?
Yeah, so there's a few things, and it's why probably both of us love listing them and love selling them. There's a number of fundamentals. I think realistically, if you look at a convenience retail asset and you strip it back from its real estate fundamentals, as Jamie said, they're main road or highway locations. Often they're corner sites. They're very accessible locations. The actual process to get a fuel convenience retail site approved, built, and actually ready for an investor is a huge process. So for an investor to actually own one, they're actually owning a rare piece of real estate. And the big fundamentals for them is often, because they're large, very highly accessible sites, they're very adaptable. Particularly if you're buying an asset, within a regional town, you're sitting at significant land sizes, but also significant traffic counts. But then if you look at some metropolitan locations, you've got significant underlying land value. And over the time and the lifespan of that fuel investment, there is readaptability. Some assets that we've sold in the past have been readapted for residential use. Some have been readapted for larger retail centres. We've seen a number of assets go through a bit of a much larger life cycle because the actual land holdings are so rare to own.
But you look at that though, and they're all on main roads. These main roads aren't going to go anywhere, are they?
100%.
To be honest, with the growth of the population, more cars, more traffic, more people.
And they're finite. There's only so many that you can actually own and approve for these particular uses. So if you own one, you've got maximum readaptability on most of these sites that we're selling.
Jamie, there's a huge price variation with what we're bringing to market. We've got something for as low as 800,000. We've got something for 17 million. What's the difference between those properties, and what are investors seeing at the bottom end of the range and the top end of the range?
It comes back to the lease. Realistically, and the land size and location, don't get me wrong, but the one that we're looking for is going to be probably around $600,000, maybe $800,000 is a ground lease, $40,000 ground lease to EG, one of the biggest companies in the world in regards to fuel and energy.
How is a ground lease different to the other leases that you're bringing to market? What's a ground lease?
Yeah, so the tenant owns all the infrastructure. So the tenant owns the tanks, the lines, the canopy, the building. You own the land, you lease the land.
So what happens at the end of the lease on a ground lease?
There's within the EG lease, there's two things. They can either revert it back to land that they were given to in the first place, or you can opt to have the building and the tanks left and you get a free petrol station.
And Yosh, with the higher end of the scale, what are you bringing to market? What does that look like?
Yeah, so I think there's a real change in that convenience retail market. It's a mixture between a number of the sites that we were selling 10 years ago, where land prices and certainly the cost of construction wasn't as high as they are now. We saw a number of single tenant convenience retail assets being built. However, now as land prices continue to increase, so do rents, so do construction prices. The ability for developers to make these assets work, they need to become more multi-tenanted assets. But it's even from a business fundamental perspective, it's actually worked really well for a lot of these convenience retail offers because they have this incredible complementary tenancy mix. We've got a beautiful asset in Upper Coomera at the moment. You've got a Caltex, a Red Rooster, and a Porto, an automotive tyre shop, and a car wash. I mean, you can't get more complementary than that, And then we sold an asset not so long ago, and going into the underlying land value conversation, we sold an asset in Robina, at Robina Central. We sold it for $34 million at a 5% yield. And there is an amazing story with that asset. You have an Ampol site, fast food users including Guzman Gomez and Starbucks, as well as an Aldi supermarket and a medical centre. And when you actually sit there for a day and you watch the ergonomics of that centre work, someone parks and they've literally stopped at each of the facilities before they've got in their car with their kids and actually left. And notwithstanding that, the underlying land value of that, coming back to that question around real estate, the underlying land value of that asset is exceptional. Over the lifeline of the ownership of that owner will own that property. The underlying land of that asset is going to go through a huge resurgence. It's going to go through some significant growth, notwithstanding the fact that they're going to have probably 20 years of income before they need to even consider seeing what that land value is going to be. And that could even be longer. So they've bought an asset that's got exceptional passive income through it, but exceptional underlying land value that they can rely on. Maybe not in their generation, but it could be the next generation coming through.
But you look at their convenience retail sort of side of things. Sorry, but we're lazy people. And we're only getting lazier. COVID made us lazy, I think. And to have a one-stop shop. And I mean, that's what 7-Eleven do, OTR, Viva. That's why Viva got into bed with Coles Express. Because they were trying to bring everything in one spot. So to have convenience retail, to get your burger, go get your car washed, go get your COVID test. It's all there. And these sites are only going to get better and bigger. As technology gets better, as these businesses evolve into being a one-stop shop, you can't go wrong.
I think the size of the site's really interesting, Jamie. We've seen fast food as a single pad site can be as small as 800 square metres, but these fuel sites seem to be substantially bigger. Would that lend itself, the end of the lease in 15 years' time or 25 years as some of these leases are, to splitting the property up or putting multiple tenants on that site because of the sheer size of them?
Of course. And you've got as Yosh was saying, it's hard to get these sites up and running, council approvals and things like that, and especially with the crossovers coming in and out. To have 2 or 3 crossovers on one property, you're coming in and you've got right in, right out, or left in, left out. Like, it's very, very important. So to be able to repurpose these sites is unbelievable. To be able to have 2, 3, 4 tenancies on one of these sites, in the future. But to be honest, you're not going to be dealing with this for another 30 or 40, 50 years.
The kids.
It's funny you mentioned that, but some of the ones that, we've sold in the past, there's active conversations happening at the moment where they're literally tacking on a fast food box to an existing 7-Eleven or BP after the fact. This is 10 years of convenience retail running, and they're actually adding another fast food box on the corner to improve that offering. It enhances the convenience retail offering, but the fast food users see it as such value to be working alongside these convenience retail offerings for their own offerings that they're butting up with these tenants, even on not just new sites, on existing sites.
But also having the fast food within the one roof line. So the 7-Eleven in Alfrington changed from 7-Eleven. I loved it. 7-Eleven was great. Kids love the Slurpees. But OTR bought the property, kicked them out, put in a drive-through.
Yep. Do they still sell Slurpees?
And my wife loves the coffee. You know what I mean? But it's so easy,
But are there Slurpees?
Do we still
okay, good.
They call it something different, though.
Well, Jamie and I were talking about it today, funnily enough, and it is one of those things, even with some of the assets that have come to market and that Jamie's putting to the market over this next portfolio. They are a different offering. There is, to have such a large convenience retail box with multiple tenant covenants in there, that one-stop shop conversation happens, and it's something that doesn't, I think we're going to see more of, and I think that is it is definitely the transition that we're seeing with convenience retail. We're going to see these sites become larger from a retail box perspective. We're going to see the hybrid nature of these facilities then, serve fuel. There's probably going to be a hydrogen discussion. There's going to be an EV discussion, and you're going to go in. You're going to get your milk, your Slurpee, your eggs, your bacon, whatever you need. So
your donuts.
Your donuts. You'll be able to do that as these sites transpire. I've got an investor that I've been doing for a long time. He loves 7-Eleven. Absolutely loves it. And you know why? It's because he's seeing what the international business is doing overseas, and he can't wait to see what they're going to be doing in Australia post this takeover. And I think all these fuel and convenience retailers are heading in the same direction.
Now, Jamie, onto OTR. So obviously I looked at the list next auction. A lot of them are co-locating, which we've talked about. How does OTR do that differently, the co-location of the second tenant?
So in South Australia, they bought the franchise for GYG, Hungry Jack's. They've got a bakery in there, but they've got and also tobacco shops. But they've bought it all in house, so it's all under the one roof. It's quite smart, isn't it? Like, you can build these. You don't have to go back to head office. You don't have to go get a franchisee. You don't have to do. You're rolling these things out. So a lot of their sites now, and especially the new ones they've built over the last sort of 5 years, have a drive-through component, whether it's fast food or even their own component, like for their own coffees and things like that. So again, you asked about the land sizes. This is what's going to happen. They're only going to get better and bigger, and the boxes are going to get bigger to be able to house more of these fast food outlets to make it a one-stop shop.
Okay, Yosh, now tell me, how much are these things going to cost me? What kind of yields are we talking for these sort of assets?
So there's a range. There does range, and from a number of different fundamentals. Tenant covenant, lease tenure, location. I think certainly Jamie and I have sold a number of metropolitan locations with yields, sub 4%. I don't know, and then there's one that's sub 3%. So there are some different fundamentals that you can see there. At the moment, certainly regionally, most of the assets that we traded regionally within pretty much all the major convenience retail players are in the circa 6% mark. We have seen a few that have been more, later fives. But then as you come closer into the metropolitan areas, they start to get tighter and tighter. Obviously, our underlying land value is a really important question there, which does feed into that yield discussion, and that's where we've seen assets that we're marketing and we've sold, and in the last 12, 24 months where things start to get to 5%, and if you've got significant tenants, fast food tenants aligned with it, it could go sub 5% and things like that. So there is a range, and I think that's where for Jamie and myself and a number of our investment specialists at Burgess Rawson, that's our craft. It's about teaching these investors where the value is with a number of these assets, why you might be paying a sharper yield for option one compared to another asset here. But it's why I love the sector, because if you want a more real estate value proposition from a land perspective, you have options there in convenience retail. If you want to buy something that's a bit more high yielding, you still get the equal and same covenant, but you're happy to go for a bit more of a high yield, more regionally. There is an option there for you as well. So there is the investor pool for these assets, and the optionality for investors is huge in convenience retail. Jamie mentioned the ground lease he's got at the moment under $1 million. Like, that's amazing. You can get a global tenant.
I feel like I should buy it.
I know. I think it's.
But if the tenant left, you've got a servo.
It's beautiful.
It would have cost you twice that amount to build.
You physically can't replace those assets for those.
Talk to me about the triple net leases. So as a landlord, what do I get under a triple net lease?
So the tenant. So with the ones that we're selling at the moment, the ones that OTR has sold to Viva, we're selling on behalf of the family. Those triple net leases, the tenant pays all the outgoings, including land tax. However, it's on a multiple holding land tax.
Wow.
Which again, rare. You don't get this very often. So Viva Energy are paying your multiple holding land tax. They pay structural maintenance and repairs. So anything that happens to the site, whether your roof blows off, your door breaks, a bit of concrete breaks, within the property, it is the tenant's responsibility. Viva have to pay for it. So to be honest, we're selling some stuff for some assets for Waypoint right now, the Waypoint REIT. Again, their leases are triple net. And you talk to those guys and they get a check every month. They don't do anything else other than bank a check and do some accounting.
And is there still depreciation on that, or how does the depreciation sit?
Well, it's even better. You own all the infrastructure. So as an owner, the highest depreciable items within a fuel site is underground.
Mm-hmm.
So to have a brand new site, which we've got a couple of at the moment, so you've got tanks and lines underneath, you've got the box, you've got concrete. So they're highly depreciable items, and the tenant is responsible for them.
Jamie, EVs, let's talk about it. What are your thoughts on EVs, and do you think they'll be the end of fuel?
They're not going to be the end of fuel. And I've spoken about this a lot over the years, and I won't claim it. Chris Brockett gave me the commentary around this. The federal government can't roll out the NBN, and it's taken them 10 years, and it probably still hasn't been rolled out properly now. Let alone infrastructure for electric vehicles. You know, they need so much upgrade, whether it's to the fuel site, whether it's to your home. I firmly believe that they've more or less given up on the NBN, and now it's gone to 5G. That, you know, you can see it. You can sort of already see this sort of happening in the EV market already. You know, we've been past sheds with Teslas, jam packed, just sitting there waiting to be sold. And I sort of go back to that, like, what, you know, great technology around it, but I think there's a lifespan for it. And at the moment, that lifespan is what we know is 10 years. And I was talking to a car dealer only yesterday up at Bendigo, and his commentary was, well, do you go out and buy a second-hand phone? There's no second-hand market for EVs. Great idea with the technology, but it's, you know, there will be it's going to stay. And you know, Ampol were at the forefront with rolling out their sites, their charging sites on their forecourts. They've slowed that down. So my personal opinion, I think you know, there'll be different types of fuel, but it'll be it's either hydrogen. You know, it's going to be, there's other greener fuels coming out as well. I still think, you know, there's going to be a part for it, but I just, you know, I think it's so far away that you know, McKinsey's have done a study recently. 49% of people that own an EV now will buy their next car is going to be back to either petrol, probably hybrid, or diesel.
And with these fuel stations, who owns them, Yosh? Who are the investors who own these things now? Who's buying them? When you bring them to market next auction, who are our buyers and who are our investors?
Yeah, so yeah, it's a good question. I think the landscape has changed. You know, I think from, you know, certainly in the last, you know, decade, I think, you know, where what has predominantly been a private investor market, and certainly real estate that's been owned by a number of the global fuel giants anyway themselves, so they own and operate these sites. We've seen a real push from, you know, institutional funds, listed funds, who are really pushing, you know, who've done some serious acquisitions in this space. You know, Jamie's doing a lot of things with Waypoint. He's just done a few things with Dexus. You know, Charter Hall. I had the privilege of going to an event only last week, and Avi was talking about the convenience retail fund that they currently have, and how defensive it was, you know, and it's amazing when you talk to some of these funds, and they are some of the most sophisticated investor groups in the Australian market, and so if they see value in it, anyone should see value in it, and I've really, it's been a great privilege to talk to a number of those people about it, because the positivity around the current market and the future of the sector, it just continues to grow. You know, and it's an amazing story, and I think we're going to keep seeing that growth as things start to transition.
But you'll see what we've all seen is a lot of these guys collect them.
Yes.
They don't own just one. They own 2, 3, 4. And whether it's a variety of different operators, we've got some guys that are probably some of the biggest 7-Eleven owners in the country that we work with.
Yeah. Actually, funny, Jamie and I regularly talk about different investors, and we've had the privilege of working on a number of properties together, and the amount of properties we've either sold together or sold to investors we know, and it might be a New South Wales property, and then I've sold it to an investor in Vic through Jamie, or vice versa, and Jamie goes, "Oh, that's my 6th one with that investor," or he's actually got a portfolio of 12 of them, and he will only look at another one, So we've recently sold a fuel site, in Lismore. We sold another one, and that owner probably has 6 of them. We sold another one in Lavington. He told me yesterday this is his 6th. So people have such a comfortability and confidence around the sector, because if you've got a global convenience retail tenant, I can almost guarantee you the rent has always been paid on time. You know, it's just like clockwork.
So, Jamie, in 2019, you bought some 23 7-Elevens to market, sold all of them. It was incredible to be by your side and watch you do that. Take a guess. How many of those do you think have come back to market since then?
2
out of 23. So I suppose that talks to longevity of these properties and why people are keeping them. And then of those people, of the people who bought the 7-Elevens in 2019, how many have come back and bought more from you?
5.
Right. So that talks to the surety of the market as well. Okay, guys, question for you. I'm going to give you $5 million each. Which one of the fuels this next auction are you going to buy?
I'm going to let Jamie go first.
Well, I'm going to take Yosh's $5 million cash, add my $5 million cash, go to Macquarie and get another $10 million in cash. So realistically, there's a number of these assets that I look at buying, and to be honest, whether it's 7-Eleven, whether it's Viva, whether it's EG or Ampol, we've just talked about it. Their longevity, they're some of the biggest companies in the world. Why wouldn't you invest in them? You're probably investing in them in your super anyway. So why not hold the real estate, get the growth in the real estate, not just in the business, So, for these types of assets, I mean, look at the South Australian assets, no stamp duty, tick. You look at something like up in New South Wales with the 7-Elevens, you're getting your Porto with it. There's not one property I would not buy that I put to market, to be honest.
Wow, that's a big call.
Well, but you look at the other ones, like say just some of the assets, Toowoomba, for instance' sake. We're selling it on behalf of Waypoint. It's out the front of Grand Central Shopping Centre. 10 million people go to that shopping centre every year. You're parked out the front. They leave? Great. Okay, I've got an amazing piece of real estate that has 10 million eyes every year on it. You go back to the fundamentals of real estate.
Yep.
Yosh, your $5 million. What are you doing with it?
Jamie took my word. I'd from a leverage point of view, I'd get my 5 and go again. Make sure I go to the bank to make sure I got a bit more money to go. I think out of the properties we have at the moment, my big push, I think there's a real key market for these multi-tenant fast food and convenience retail assets.
I love multi-tenanted dual.
And I actually think it's a hidden gem. I think we've been selling. You talk about fast food before. We're selling fast food, in the 3 to 4% and consistently. So, and that's in the markets that we've seen interest rates move. We haven't seen fast food move minutely anything really. There has been in the last portfolio we traded a Hungry Jack's at 4%. We did a McDonald's at 3% for a ground lease. In Newcastle, and I look at something like an asset like we have in Wodonga at the moment. You get a 7-Eleven and an Porto. And the likelihood is you're not going to have to pay those type of yields, So you get the strength of a global convenience retail covenant from a rent perspective. You get the beautiful recession-proof fast food with it, and you're not paying the same type of yield. And I think at the moment it's a hidden gem, and that's where I think there's a really nice way to drive a bit of value. For myself personally, I think there is a line just thought pattern around where that asset can grow. There's so much readaptability. Often those multi-tenant sites are much larger facilities as well, and they've just got this complementary tenancy mix, and you've got a diverse income stream. For some people they would prefer to buy a single lease similar to the ones that Jamie has, which is still multi-faceted fast food and fuel, but there is a single lease. But some investors actually prefer to have diverse income streams. They get rents from 2 different covenants. There's a risk prevention there that they feel is there. I think it depends on who you are as an investor, but I do see them as a bit of a hidden gem.
Jamie, quick fire question. Favourite site this auction?
There are a number of favourite sites, but I want to bring you back to just the one that I inspected a couple of weeks ago. And we're selling it on behalf of the OTR family that started OTR. It's incredible. It's in West Croydon, north of at the Adelaide CBD by about 5k. So you're talking pretty close to the CBD here. It's on Port Road, main sort of thoroughfare leading back in from the north to Adelaide. It has got a convenient sized store that's got more or less a mini supermarket in it and a Subway. But the other key attributes to this thing that I loved about it was, the size of the land, 5,500 square metres, 50 odd car parks, but you'll never see this thing ever a 2-story Krispy Kreme outlet with a drive-through, with the cafe, the
manufacturing them on site, aren't they?
So you've got everything there.
That's
so
amazing.
they manufacture. I saw the lady cooking donuts there while I was there, and then what they do is they distribute to all their other stores out of this one store. So, you've got this amazing piece of real estate leading back into town, one tenant, triple net lease, but you've got something that, you've never seen before, 2-level Krispy Kreme.
And it's brand new. It's a beautiful site. Like I just looked at it, I could not believe it. It's take your breath away stuff.
Oh, I saw some images this morning.
Yeah.
It looks really good. You don't see that very often. Big box, big convenience retail box, big fast food box. And I didn't realise it was actually 2 levels. That's unbelievable.
But Jamie, one rent payment from Viva.
A brand new 18-year lease.
Yeah, but Krispy Kreme pay Viva. Viva pays you. So you've got one lease.
OTR own the business. So,
Wow.
They've been that progressive in the market and building their empire in regards to their business. They've been able to roll these things out across every one of their stores as well.
And the Shaheen family in itself is a story of true success. Refugees arriving in Australia, first fuel station in 1984, starting the OTR business in 1999, in a short 13 years, selling it for how much, Jamie? What did they sell for?
1.15 billion.
Wow.
To Viva. And again, you look at that, why are these big companies buying these sites? They need to be expanding, and they're going to be the aim. My understanding is their aim is to roll out the OTR model throughout the Viva portfolio. So, the old model with Coles Express was probably a smaller shop front, and just keeping it very tight and small. Where, as we can see with what 7-Eleven have done, is having everything in a one-stop shop. So they're going to be rolling out more of these bigger convenience sites, bigger fast food sites. It's the market's changing. The whole landscape's going to change.
And I suppose part of that is obviously metro infill. There isn't simply the land to put a whole supermarket. Woolworths and Coles can't find new sites. This is providing the supermarket model on your corner because you can fit it on a far smaller site that simply Woolworths and Coles and Aldi can't fit on.
Yep. That's 100%. That's why we're seeing the Coles Locals of the world and the Woolworths Metros of the world open in these metro locations. You're exactly right. The land allocation we're so landlocked, across the eastern seaboard that these are the offerings that are going to be relied on.
But you look at the Coles and the Woolworths sort of model. They can't get the car parking. They can't get the access. Yeah. Where these guys have already got the access. And they've got the car park.
And the simple convenience factor means that you can pop down the road, you can get anything you want, and those are extra sales that are going to constantly add to the brand.
100%. It's exciting. It's what excites me about it. It really, honestly, it's what excites me about the space in general. Like that
fuel is one of my favourite industries. I have to say, I do love it.
It's got the most, probably the most adaptability and growth at the moment, and it's so widely talked about the changes. What Jamie mentioned, bigger boxes, ancillary fast food tenants. You're buying your tobacco, your fast food. You're getting your convenience retail fuel and maybe there's some hydrogen and probably other fuel sources down the road that will be readapted on these sites. But you need those sites to be readapted. There's no other real estate that offers you the fundamentals of your main road sites, such accessible land holdings for you to do. It has to be those. So I'm really excited to see how they continue to transform.
Jamie, favourite ever sale that you've done of a fuel?
Oh, there's been probably 2. So for about 15 years, going to the airport probably once every 2 weeks. Bell Street, 7-Eleven, just before you get onto the Calder, out to the Tulla. So that was one of the best ones I've done. That was one of the first 7-Elevens we sold for 7-Eleven. And probably going back to Hawthorn 7-Eleven as well, at the bottom there of Toorak Road. Again, it's a site that, as I moved to Melbourne 20 odd years ago, that was the first thing I saw because I lived in Camberwell. I'm like, wouldn't that be cool to sell? So for me, nice. those 2 sort of stand out. But you know what? There's a lot. I've sold a lot of convenience retail, and there's a lot of cool sites out there. That we've sold over the journey. And you know what? There's a lot of happy purchasers out there that have just received income after income after income. Like you just get your rent, and even I think for the future of them as well, they're only going to grow bigger. Whether they need a bigger box or whatever it is, they're not going to move from these sites.
Yosh, favourite sale?
I don't think I can get past Robina.
I love Robina. It's beautiful.
You know, I think amongst all of us, we know the asset well, and it was a phenomenal piece of real estate, and I think it represented one of the largest convenience retail sales that had ever occurred. So it was a beautiful land holding, high underlying land value. Ampol anchored that side alongside Aldi. It just had all the earmarkings of being a really supreme piece of real estate. So
medical, and the Aldi with the preparation for the click and collect. That unreal. Aldi was just absolutely beautiful.
Full essential service.
Yeah.
You couldn't pick a better tenancy mix. I'm probably similar to Jamie. I think over the last 10 years that I've been doing fuel, it's certainly there's a number of nice ones. But that one's probably the closest to home at the moment. It was a fantastic sale, and
DeLuca provides great product. Like, they build really, really well, so you're getting
unreal.
incredible quality. They put together a site exceptionally well.
Oh, they're one of the best in Brisbane.
Yeah.
It's and certainly I think that's it speaks volume to the investors as well. That was part of our discussion with them. It was built to quality, quality build, quality tenants.
Yeah, and that's something that we've seen. There's a lot of concern now at the moment about quality of construction, longevity of construction. I know certainly in the residential investment space, that is a major concern of investors who are then lumped with huge capital costs. Whereas this stuff is built much better because often it's built by the tenant or built by very, very trusted developers that the tenant trusts. Is that what you're saying?
Well, they're specialists. They're specialists in the design and construct.
Mm.
It's interesting when you talk about those build costs. Even this asset we're doing currently at Upper Coomera, you've got some of the tenants I mentioned before with Caltex and Porto and Red Rooster and the auto shop. The significant moves in land rates and construction costs. You physically can't build that asset today for the price it will probably sell. Like it is amazing. And that is, I think, amongst a lot of the assets that we sell on a number of asset classes, but fuel, particularly larger fuel assets or larger convenience retail assets in general, that replacement cost discussion is huge in the market at the moment. As I mentioned, literally if someone bought that land today and they built an identical property, they wouldn't be able to build it for what we'll probably sell it for. And I think that story is prevalent across the market at the moment, which is important for investors to know. They're buying genuine real estate value more than they ever have.
So to summarise, guys, and I really thank you for your time today. It's been so enjoyable hanging out with two of my besties. You're telling me that we've got really, really great leases. We've got great tenants who pay. We've got strong underlying land value. And from a price point, we've got something for everyone. Is that really a great summary of why fuel and convenience is the way to go?
I think you've hit it on the head.
Yeah. There's something for everyone.
There is.
Yeah. And whether you're a first look, in particular, if you're a first timer, some of these assets, you pick up one of these assets that's triple net, you actually don't do anything other than collect the rent. As a first timer.
And security of income, we've all been doing this for a long time. The convenience retail is probably the asset we've never ever had any issues on.
Yeah.
Once we sell them, I can personally say on every asset I've sold in convenience retail, I've never seen an owner call me and have an issue with it. Rent's paid like clockwork, site's managed by the tenant really well. I have got to a point with some investors where I sold the asset to them, and when they bought it, they'd never seen it. And when I'd gone to sell it, they hadn't seen it. And I'd given them the IM, and they said, "Oh, that's what it looks like." And that's how management free that. Yeah. They've gone through this life cycle of owning this asset for 5 years, and they've never seen it. When they bought it, when they sold it, and when they moved on to the next asset.
But talking about first-time investors, Burgess Rawson does have an industry report that they can access from our website. They can read that and get some really good information around it. You guys are also obviously available to answer their questions and to help for first-time investors when they're entering into the fuel market. And I suppose what for first-time investors would be your biggest point of advice, Jamie?
Just making sure that lease is right. If you're thinking about these, it's really with any investment, really. From what we sell, from childcare to fuel to fast food. Going back to making sure that tenant is who they are on the lease. And look, personally, key locations for us.
Yeah.
Like that's that first, and to be able to have an asset as a first time investor on a highway or a main road site that you can go past and have a look at every day. How cool is that?
Yeah.
Oh, thank you guys for your time, and I look forward to catching up again soon.
No, thank you.
Thanks, Yosh.